Hello and welcome to Earnings Echo. We put together the most important information about SAP. Total revenue for Q1 2026 hit 9.6 billion euros. That is a 12% increase. And non-IFRS EPS surged 20% to 1.72 euros. The immediate question for anyone holding this stock is whether this execution changes the trajectory for the rest of the year.
Well, the full year 2026 guidance remains strictly unchanged. Management is holding firm on their target of 25.8 to 26.2 billion euros in cloud revenue.
And the 10 billion of free cash flow, right?
Exactly. Which really signals this highly confident execution, cutting directly through all the current macroeconomic noise.
Wait, operating profit shot up 24% to 2.87 billion euros, but free cash flow actually dropped. It went down by 9% year-over-year to 3.25 billion. How exactly does that math work? Are they burning cash to achieve that growth?
No, not operationally. So that free cash flow decline is an explicit one-off distortion. It was caused exclusively by a 408 million euro payout for the Teradata litigation settlement.
So a legal payout, not a structural issue.
Correct. Adjusted for that settlement, the free cash flow progression is actually positive at 2%. The real operational story is the segment breakdown here. Cloud ERP suite revenue accelerated by 30%.
Which is massive.
It is. And that fundamentally drove the overall operating margin to a really robust 30%.
Right.
But at the same time, traditional software licenses plummeted 33%.
Right. It's like tearing off a Band-Aid. They are, letting those old one-time DVD sales of software die off completely, taking a short-term hit to lock clients into a recurring Netflix-style cloud subscription.
Yeah, that recurring revenue model.
Exactly. And that's exactly where the margin expansion comes from. But if you're looking at your portfolio right now, you have to weigh this structural cloud growth against the macroeconomic environment, because management maintained a very disciplined tone on the call regarding external pressures.
Yes, CFO Dominik Asam was very clear about supply chain contagion originating from the Middle East conflict.
Right.
He warned that this is forcing immediate firefighting among their energy-intensive manufacturing and logistics clients. Because of those specific pressures, and the fading of certain Q1 tailwinds, Q2 cloud growth is expected to slightly decelerate.
Okay, so if Assam is warning about supply chain firefighting and a slower Q2, how is the market currently pricing that risk? Are they fully baking in that pessimism?
We can isolate market expectations using a reverse DCF.
Right, where we work backward from the current stock price to calculate the implied future cash flows.
Exactly. So at a 181 billion euro market cap, and assuming a 9% weighted average cost of capital, the market is only pricing in a 6.2% free cash flow growth over the next 10 years.
Wait, hold on, let me get this straight. The market is pricing SAP like it's only going to grow cash flow at 6.2%, but management is practically guaranteeing 21% growth to hit their 10 billion target for 2026.
That is what the data shows.
That's a massive disconnect. That is the alpha right there, especially when you factor in the 2027 catalyst.
Exactly. The transition timeline provides a hard floor here.
Because SAP is essentially forcing their clients' hands. They're ending support for their old legacy system, the ECC, in 2027,
Right.
which forces thousands of enterprise clients to migrate to the new S/4HANA cloud system whether they want to or not. With that built-in catalyst, a 10 to 14% compound annual growth rate is highly probable. The market is pricing SAP like an ex-growth asset, while cloud revenue is actually expanding at 27% in constant currency.
And that built-in engine is just part of a broader long-term investment story. SAP is positioning itself as the AI-powered institutional brain for enterprise clients. By integrating deep domain knowledge with AI agents, they embed themselves irreversibly into client infrastructure.
Plus the internal efficiencies.
Precisely. They are utilizing internal business AI to target 2 billion euros in run rate efficiencies by the end of 2028.
So for you, the investor, the final echo is this. The structural cloud shift, combined with a massive 10 billion euro share buyback program, offers a strong fundamental floor, provided global macroeconomic risks remain contained. Consider whether the broader market is chronically underestimating the compounding cash-generating power of mandatory software migrations deeply embedded across global supply chains.
It's definitely a structural advantage worth digging into.
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.